any discussion about employee benefits will invariably focus in on those things called post-employment benefits, retirement benefits, and of course more usually called pensions or pension schemes. So IAS 19, the standard dealing with employee benefits, of course covers a really wide range of benefits. Those benefits, of course, are the compensation to the employee as a result of providing service to the entity. So of course we're going to include within that range obviously wages, obviously salaries, bonuses, sick pay, holiday pay, termination payments. But of course, as I say, invariably we're going to come back and really focus in on the accounting for pension schemes. So let's have a look at these types of scheme. Of course, there are two types of scheme in the real world and for accounting purposes. Those, of course, are the defined contribution scheme and the defined benefit scheme. Well, of course, if we look within the standard, it is the defined contribution scheme that is the one that is defined. So a defined contribution scheme is one where the entity agrees to pay a fixed level of contributions into a separate fund and has no further obligation, either legal or constructive, to pay further amounts. Any other scheme, of course, is going to be a defined benefit scheme. So any scheme that does not have the characteristics of that DC scheme will be a defined benefit scheme. For accounting purposes, the defined contribution scheme is actually pretty straightforward. And let's look at the reason for that. It is a scheme whereby the entity agrees to pay a fixed level of contributions into a separate fund and has no further obligation once it has done that. So that of course means that once the entity has paid across to the fund the amount that it agreed to pay, let's say 10% of pensionable salary, then once it's done that, it has got no further obligation to do any more. So if the entity in any one year pays, let's say 9%, but has actually agreed to pay 10%, yes, there is that obligation to pay the further 1%, but that's as far as it goes. It is very straightforward accounting, and of course following the matching concept, as the employee provides a service, then the charge to the entity is going to be the contributions payable. Not the contributions paid, because that is based on cash flow, it is the contributions payable. So obviously, as I've just said, if the entity is only paid 9%, then the charge will be the 10%. Equally, if the entity is paid 11%, then the charge again will be the 10%. So at any one point in time, we might have a short-term prepayment, we might have a short-term accrual, but that is really as far as it goes. Very straightforward accounting, and therefore pretty straightforward disclosures as well. So invariably the complications, invariably the testing comes with the defined benefit scheme. In fact, there is a similarity between the DC and the DB scheme, and it's really one similarity, and it is the cash flow, the contributions that are going to go across from the entity to the pension fund. For both the DC and the DB scheme, there will be that cash flow being paid across from the entity into the fund. But really, that is where the similarities finish. Actually, there is one more similarity, and it is the concept that we're dealing with. Because regardless of whether it's the DC or the DB scheme, the principal concept, the fundamental concept, is the one of matching, i.e., as the employee provides and continues to provide service to the entity, the employer, must record a cost for that provision of service, even if the employee will not actually receive the benefit, the cash flow, until a later period of time. It, of course, is that great thing of matching the accruals concept. So let's look a little bit more at the defined benefit scheme. Remember, it is the benefit that is in essence being defined, and what actually is meant by that is that the employee will have some understanding that the benefit that they will receive, the pension that they will receive, when they finish work, when they retire, will be based as a function of their salary. It might be based on their final salary. It might be based on their average salary. But however it is determined, the key thing is that the benefit is not solely a function of the contributions. That, of course, is the essence of a defined contribution scheme. So, for example, if I'm invited to join a pension scheme and I know that when I retire, let's say in 30 years' time, I will receive a pension that is based on 50% of my final salary, then I've got an understanding to begin with that that is what my benefit will be. Now, the important thing is that once that has been determined, then it is the obligation of the entity, of the employer, of the company, to make sure that there is sufficient funds available to meet that obligation. Of course, and the obligation continues until I effectively pass on. That might be 10 years after I retire, it might be 20 years, it might be 30 years. Now, straight away, we can see that there is a big difference between DB and DC schemes. Remember, with the defined contribution scheme, the obligation of the entity effectively concludes once they've put into the pension scheme the amount that they agreed to put in. With a defined benefit scheme, the obligation of the entity does not finish until I have left the scheme. And of course, that is usually, in a very simple scenario, that is usually going to be when I pass on. Now, hopefully we can see from this scenario that with a defined benefit scheme, we've got an obligation that is going to be settled many, many years in the future. And that obligation, remember, is not going to finish until I leave the scheme. So let's imagine that I retire in 30 years and I live for a further 20 years after I retire, and my pension is going to be based on, let's say, 50% of my final salary. Well, straight from the point that I start providing service to the entity has to record a cost. As I provide service to the entity must record a cost for that service. Now, in defined benefit pension terms, we call that the current service cost. It is the ongoing cost that the entity records as the employee provides service. So, I work for 1 year, the company records a cost for 1 year, 1 year's current service cost. I work for another year, I'm building up benefit, the employer is recording further cost. Each year, as I work for the company, the employer is recording this current service cost. Now, one thing we have to remember, of course, is that this obligation is going to be settled many years in the future. And hopefully that should bring to mind to all of us that whenever we're dealing with any obligation that is going to be settled a long time in the future, we have to consider discounting. So, based on my little scenario here, what the entity will do is that they will calculate a discounted present value for the current service cost. In essence, what they're going to do is with the help of what we call the actuary, they're going to try and work out what my final salary is going to be. They're going to try and work out how many years service I'm going to provide until I retire. They're going to effectively work out how long I'm going to live for after I retire as well. And then they're going to chop that up into years service. And each year that I provide this service, the company will then recognize 1 year's worth of that current service cost at present value. Now, this of course brings into play something also very, very important with defined benefit schemes, this whole issue of discounting, i.e., at the end of 1 year, if I'm the only individual in that pension scheme, the company would have recorded 1 year's worth of current service cost at its present value. Well, let's just think about that, because when we then go through to the beginning of the next year, we've got an opening obligation. Well, even if nothing else happens, that opening obligation is going to grow because of the unwind of the discount. Because of course, as we get closer to the obligation being settled, as with any other obligation, that obligation grows and grows and grows. So let's just go back. In year one, the company records 1 year's worth of current service cost. We have a closing obligation, we have an opening obligation at the beginning of year two. In year two, that opening obligation will grow because there will be an interest cost to represent the unwind of the discount. But then also in year two, there will be a second year's worth of current service cost. So that by the end of year two, that obligation is an amalgamation of the current service cost from year one, plus the unwind of the discount on that current service cost, plus the current service cost for year two. And on it goes, and on it goes, and on it goes, and on it goes, and on it goes over the years until I retire. That is, if you like, one side of the coin. The other side of the coin is the fact that, remember, the company will be paying into a separate scheme a level of contributions. Those contributions will be used by the pension trustees to acquire assets. Those assets might be land, it might be property, it might be stocks, it might be shares. But at the end of the day, whatever those assets are, the trustees will be looking to get a return on those assets. They want those assets to grow. Now, for pension purposes, we use exactly the same discount rate to calculate the interest income on those assets. We use exactly the same discount rate that we use for the obligation to calculate our interest cost. So, let's think about this. In year one, the company pays across contributions into the fund. The fund uses those contributions to buy assets. If that was at the beginning of the year, then by the end of the year, those assets will have grown by that interest income that we would have calculated on those assets. So, i.e., at the end of the year, we'd expect the assets at the end of the year to be greater than the fair value of those assets at the beginning of the year. And again, what is going to happen is in year two, more contributions come across, more assets are acquired, but of course we add on the interest, we add on the growth, we add on the growth each year. So we've got two things going on. We've got the obligation that is growing because I'm providing service and there's the interest cost. We've got the assets that are growing because more contributions going into the scheme, more assets are being purchased, and there is the growth of those assets. And then what happens is there is the retirement of the individual. What's going to happen? Well, when the individual retires, they of course will start drawing down that pension, which of course means that the obligation starts to decrease. What is actually going to be the payment? The payment of that retirement benefit is going to come from the pension fund. The pension fund, of course, is using the assets that it has available to it. It's going to crystallize those assets, liquidate those assets, convert them into cash, and pay them across to the employee, i.e., as the employee retires and starts to draw down their pension, the obligation starts to decrease and the pension assets start to decrease. So, obligation decreases, assets decrease as the employee draws down their pension benefit. During the period of working for the entity, the obligation increases, the assets increase. Now, if everything was going according to plan, what we should expect to see is the obligation is met by the assets. So in actual fact, in the balance sheet, we would see nothing. We know that in reality that is not going to be the case, and invariably there will be a difference between the obligation and the scheme assets, and usually it is the obligation that is greater. So what we're going to usually find at any point in time within the statement of financial position is a net deficit position, where the obligation of the company is greater than the scheme assets that effectively are going to be used by the pension fund to pay down those benefits. Now, that is quite a simplified, straightforward, if you like, diagnosis of the essence of the defined benefit scheme. There are other issues, many different issues to consider, but in essence, that is the principal characteristics of the scheme and shows the differences between the DB and the DC scheme.